Good morning and happy Friday to you. My name is Jared.
My name is Isaac.
And this is the Reino Ordonez 5 Diamond Group podcast. You know, when it comes to purchasing a home, how much money do you think most people, let's ask the question. How much down payment do most people think they need to purchase a home?
A lot of money, 20%.
20%. I would wager a guess that most people think 20% is the down payment that you need to buy a home because it's it's been most advertised, and it has actually a very good strategy to buy. But what if we said?
Well, even when you go like on Zillow, and you get like your estimated payment, and you see like $1,100 for a $350,000 house, and you're like, well, I can afford this because my rent's $1,200. But then you see this is calculated based on a 20%
down payment. What if we told you that you can actually purchase a home for 10%?
5%.
Lower?
Yeah.
How about 3.5%?
How about 3%?
What if we said that you can get a home today, in today's market, for less than that?
That would be crazy.
Right? So even in today's competitive market, in this episode, we're going to talk about money and how you can purchase a home now and why it's so important not to wait. Money. I don't really like money. Did you ever watch Idiocracy?
No, you've been telling me to watch it.
Okay.
Just the name.
Okay, it is. So it is absolutely the dumbest 2 hours of your life that you're going to spend. But there's a line in there that just came to mind. Like, I like money. I like money. Anyways, so last week there was...
If you guys watch that movie, drop it in the comments below.
Drop a line. It's hilarious. In fact, there's a whole ideology that I think, but anyways, last week in the news, speaking of Idiocracy, last week in the news, there was a very famous person that paid only $750 in taxes to the IRS, not just once, but multiple years on end. Now, not condoning it, we're not even going to dive into the conversation of whether it's ethical or not, but there is a strategy that was used in order to get there. And that's called deductions, or depreciating assets of some sort. And the only way you can do that is you own certain things, right? If you're renting, what was that comment that you sent over?
Don't get mad, don't hate because billionaires don't pay taxes when
you're renting.
When you're renting and throwing money away or something like that. Here,
right.
I'll look at it.
So the bottom line is, there is that challenge, that economic gap, right? If you're currently renting, it's quite possible that being able to purchase a home has its challenges altogether. And we recognize that. And that's part of why this episode is here, to be able to help renters, homeowners, anybody purchase a house and kind of demystify all of the questions most people have on that. When was the last time you paid $750 to the IRS?
No comment.
I think I was 17. It was like I was working part-time after school or something.
So here's a quote that I found. Instead of being mad that the wealthy don't pay taxes, realize that there are 0 tax deductions for renters.
That's the key point. 0 tax deductions for renters. So the only way to really kind of start that trend, we're going to pick up from last week's episode, how professionals diversify in real estate. You start with your nest egg, your investment, right? Get into that multiplex property and purchase it. Well, let's get some practical advice on how to do that. If you were thinking about starting in your first purchase as a home, well, think of it from, go check that episode, go hear what our friend Eric Palacios and what we have also suggested to our clients, how you can get your future started in the wealth of real estate by starting that portion of it. But today we're going to dive into how we can do that from a practical method, even with little or even in some cases no money out of pocket. And we have cases from our clients that have succeeded in doing that. So let's dive in. Let's get that started, right? Let's see. Home ownership is the only way to start that process. So when it comes to renting, the goal is just stop renting and own a house. Because if you're paying that monthly rate, that's going into not your pocket, not to your family's wealth, but to someone else, your landlord, or even the company that's out there that you're renting from. So when it comes to purchasing a home, let's just break it down into each segment. This is conversations that we have every day with our clients when it comes to purchasing, and anyone who goes through the process knows that they're pretty standard requirements. First one is going to be your credit score, right? Mm-hmm. FICO, generally, what should that be around?
So that's a really good topic, because a lot of people think that you need like amazing credit,
right.
700, 800s to buy a house.
Right.
So you can buy a house with as little as a 580.
That is right. Almost every lending institution will allow lending for credit scores at 580 or higher, even Wells Fargo. Just keep in mind, though, if your credit score is that low, the difference that you're going to pay is now in your interest rate. Mm-hmm. They're going to give you a higher interest rate because it's more risky for them, right?
Yeah, I was just going to say that it's called risk-based pricing. So the higher your credit, the more financially responsible you seem to be, whether that's true or not. Wait, I'm going to cut that out. I don't like that.
Okay.
So it's risk-based pricing. That's what they call it. So basically, the higher your credit, the more financially responsible you are. You have less debt, which is why you have a higher credit or score. So less risk for the bank, the lower the rate. The lower the rate. The lower your credit score, the higher you risk, or the risk is for the bank. So the higher your rate. So that's essentially what that is. And so yes, can you buy a home with a 580 FICO? Absolutely, but you're gonna pay for it, like Jared said, in credit or in interest.
Mm-hmm. In addition to that, if you do have a 580 score, you're probably going to pay more out of pocket because you won't be able to qualify for specific programs, and that's also what we're going to dive into today, is programs that are available for everybody in order to help you reduce your out-of-pocket expenses, right? So FICO score 580, yes or higher. Ideally, if you're in the mid 600s, 660 or higher, 680 or higher, you're going to be qualified for most of the programs that are out there. And of course, 700 and plus will always be getting you a better rate. What is the standard formula for banks when they say, oh, rates today are 2.99? That is based off of what scenario? Remember?
The prime rate.
Prime rate, right? Yes. So what's that buyer scenario? It should be a typical buyer at 780, I think, is the score that they need at FICO, and then a certain debt to income ratio. It's less than 30% in there. So that's the standard formula for those rates that you hear. If you have any variation from that, any change from that formula, well, then that's where that risk-based pricing comes in. They'll usually add a certain percentage rate on there, and that's where you end up with your rate based on your situation. That said, if you do have a pretty decent rate and you want to change the rate you get, well, then you can put more money out of pocket and buy the rate down and get you to a specific number on that rate formula. So those are the different ways the FICO impacts your qualification on the mortgage portion of that.
And keep in mind that the better your credit, the more or the less information that they're going to require from you. So if you have a lower FICO, then you may require like reserves, bank reserves, and stuff like that. So you might necessarily pay more money, but you'll definitely need more money. And so definitely working on your credit is going to be the number one key.
The easiest way.
And there's a difference between bad credit and no credit. So if you have bad credit, that means that you probably have some collections, didn't pay on time, anything like that. And those can be fixed either with a credit repair company or yourself, because like services like Credit Karma allow you to dispute a lot of those lates and delinquencies on your credit report. So you're maybe able to do it yourself without having to pay anything. Now, if you have no credit, well, that's easy.
That's different.
That's super easy, because you have no credit. You can go get a secured credit card and start building credit, and probably within 6 months have a 680 or 700 FICO, super quick. With as long as you're responsible with it, be something very simple to do.
Right. So with that in mind, when it comes to working on your FICO, like Isaac said, you could do that on your own. You can get the counseling from an agency. Some of them will charge, but get the good ones. If you need some references, request to drop a line. We can get you connected with some local services that have fantastic reputations on that. The other part of working on your credit is file a mortgage application with a good lender. If you're working with a good lender, the lender is often going to help you understand where on your credit report that they can make adjustments or improvements so that you can get in the best qualification period. And so, yeah, they're going to run your credit and they're going to review it and they're going to want to talk to you about your entire financial situation. But they are the experts. They're there to qualify you. Their goal is to help you get into a home. And so they have that perspective of what can be removed or adjusted in there to help you in that position.
And keep in mind that even if you're not thinking about buying a home in the next 2 or 3 months or even in the next 30 days, you still want to get pre-approved, because in best case scenario, you're ready to go, and as long as you don't do anything to negatively affect your credit, you'll be ready in 6 months, 9 months, a year from now. But let's say that you wait to the last minute and you needed to take care of some stuff, pay some debt down, or whatever the case may be, and you're trying to buy a house within the next 30 or 45 days, well, you're going to be stressed out and you're probably going to require more money, whether you qualify for the programs or not. So always, my suggestion is always get pre-approved, get that out of the way, find out what you need or what you don't need, so that way you're ready when that time comes.
And one kind of clause in there to keep in mind: the credit formula for a mortgage application is not the same as a credit formula for purchasing a vehicle or appliances or any other credit scenario. In fact, the credit structure, the whole FICO credit structure, was really established for home ownership. And so the rules for them to qualify you for your FICO are very different. You might have seen your Credit Karma score, but that actually might turn out to be different on the mortgage application. So with that in mind, you definitely want to get that input from an expert who sees it every day to make those adjustments. And sometimes if you've got a significant like say judgment or lien, whatever the case may be, oftentimes it's not about paying it off, it's about having that payment structure in place so that they can factor that into your qualification and go from there based on that. And so it's not necessarily, I've got to pay $50,000 to pay this judgment or whatever the case may be. I might have to be able to pay just a portion on a monthly basis and make sure that's factored in there to get going.
And I think we're going to do a separate video on this, because I'd like to go a little bit in depth, like what debt to income is, how banks calculate debt, because that's one of the biggest things that when I sit with my clients and they tell me they have a lot of debt, and then I look at it the way the bank looks at it, it's really not a lot of debt, or vice versa. So just if you guys want to know about that, we'll do another episode on that and kind of do a little math, because some fun math.
Yeah, just to kind of put it in perspective, the line I hear quite often is you could be making $1 million or you could have $1 million in debt and still not qualify one way or the other. Mm-hmm. It's based off of the monthly income and your debt to income, as Isaac says.
So going back into buying a home, credit is very important to be able to afford or to buy a home with the very least amount of money possible. Yeah,
and it doesn't have to be super sterling silver credit. Even in rough situations, just a little bit of adjustments can help you get into that 600 range and move forward with qualifying on your credit. So definitely take a look at it and definitely talk to the experts, because that's what we're here to do, is to help you get into that position so you can purchase.
And we always push who you work with matters, and that can be more important when it comes to the lender, because the lender that we typically work with runs the different scenarios, looks at the options, because sometimes we have a client that's just 2 or 3 points under what the qualifying mark is for a down payment assistance program, and they give suggestions and they give recommendations as to what to do to push that credit over that requirement, and that makes a difference from just saying, sorry, you can't qualify, move on. And so that could be discouraging if you're not working with the right person.
Nailed it. Down payment. That's going to be the next portion. That is, it's a challenge for many folks, especially if you're renting. But getting that down payment in place, and a lot of people feel 20% is required. 20% of $300,000. That might take years for some people to establish. But the reality of the matter is 20% is the ideal scenario. If you have 20% down and the bank is only financing 80% of it, well, you've eliminated a lot of other insurances and just simply went to a principal amount and then the interest portion. But the truth is that there are other programs, and quite often many, almost all the home buyers today are using less down payment. 10%, 5% down is considered conventional. FHA offers a 3.5% program, which is a government-backed program. And that is the lowest kind of government available program that's out there. There are some conventional loans that do 3%. And then on top of those, you can bundle that with down payment assistance programs. And that's where things get really interesting. So if you do the math on 3.5% or 5% down, and now you get additional funds from state or grant programs or even local area programs available for specific communities or cities, well, now you can piggyback and juggle those two things together and reduce those out-of-pocket expenses and get you into a home with little out-of-pocket. And in some cases, rare cases, if you're really adventurous, zero out-of-pocket, or you have a good negotiator.
Talking about good negotiators. Don't you have a good story about that?
Yeah, Maria. We'll put the link for that video in the description, but Maria was one of those special cases who said she wanted a house. She was able to get qualified. In fact, she had bad credit. She went through the credit repair program in 6 months, got herself up to a 700 FICO score, and not only qualified with her income, but with the down payment assistance programs. She said, go and shop and find me a house in this particular area. I don't care, as long as it has this number of bedrooms. We found her a newly refreshed home that was 4 bedrooms and was able to negotiate $6,000 in seller's contributions. When you could couple that contribution from the seller, the down payment assistance program, some adjustments in the numbers, she actually walked into that particular house with a $400 credit. This is, full disclosure, not a typical scenario, but it shows that it's possible that you can purchase a home with zero out of pocket.
And the credit in some
cases, yeah.
But I want to remind everybody that this was during a market very typical to
today's,
ours.
Yes.
It was a seller's market. Homes were, we listed a home and we got like $7,000 over appraisal value, or $5,000 over appraisal value.
In 3 days after it listed.
Yeah. And multiple offers. Like, the market was just crazy as far as listings went. So for Jared to be able to get that, got like a roof certification on it, if I'm not mistaken, right? It was just a fantastic deal, because now that house is probably worth $30,000 or $40,000 more.
Oh no! In today's market,
yeah.
I just ran those numbers, $240.
Oh wow!
Yeah.
And if she bought it for like $160,
she bought it for $140.
$140.
So in 3 years, she got
$100,000
$100,000 appreciation.
So this is a great point. Piggybacking or going into our next thing is because you're paying rent. Let's just say you're paying $1,000 a month.
Yeah.
Right? And that's low, because the average rent is what, 13 something a month here. If you're paying $1,000 a month in rent, 12 months, that's $12,000. Over 10 years, $120,000.
Okay.
Right?
Yep.
Most people,
that's how much money you're putting out just to cover roof over your head.
So let's just say that you've only been renting for 5 years. That's still $60,000 that you will never get back. Mm-hmm. Money that you're just throwing away because, look, unfortunately, the things, how things are going. Evictions are starting to happen. Yeah. I just read a report saying that 10% of renters in Las Vegas have not paid their rent. Okay. So those are about 10% of renters are looking or are at risk of getting evicted. And unfortunately, the landlords, most landlords, they bought those rentals for income, and it's probably sometimes their only source of income. So they may not be so willing to work with you if you can't pay them the rent, because they need to, provide for their family as well, right? Mm-hmm. But a bank is probably going to work with you a lot better. I've had a couple past clients who did the forbearances. They're putting 6 months worth of payments on the back of the loan, just giving them enough room to breathe, to be able to save up. And it's not maybe not necessarily that they absolutely need it, but they're just using this as a cushion,
strategic opportunity,
to be able to make sure that their family is taken care of.
Yeah, yeah. And so with that, being able to see how much money you are actually putting out in your just your rent rate alone, if that same $60,000 was actually going towards your home purchase, well, now that translates into now available equity that you can work with in your home. Now think of the market shift in those same 3 years for Maria. That's $100,000 that she would have never been able to make, even in 20 years of working. She wouldn't have been able to do that in that space of time. That is about timing, and yes, it's not typical, but in today's and this year's market, we are expecting a double-digit appreciation this year, even in the midst of a pandemic. And that's actually here locally, but as far as nationwide, we're looking at 5 or 6% appreciation. Appreciation in your home value translates into available money that you can use in a situation like this. And while it is considered something to factor in, you know, for most homeowners, that is the advantage. This is the only purchase that you can make where the value will continue to appreciate. Mm-hmm. Purchase a car, to drive it off the lot,
depreciated
of usually 10%, right? And so you're not going to get that money back. Whereas if you're purchasing towards your own property, and the home is going up, those two things, you're already paying down the amount every month, and you're seeing the market adjust. Maria is a fantastic example of how you can get into a home and take advantage of the market in today's opportunity. So,
and so using Maria as an example, or somebody like Maria who bought a couple years ago or 3 years ago, this is the power of home ownership, right? As let's just say worst case scenario, she can't make the payment, the bank's not willing to work with her, you know, she needs to figure something out. What is her solution? Well, sell a home.
Right.
Now she has $100,000 in cash that she can turn around, either, you know, use it to survive for the next, you know, couple years, because that's 2 or 3 years worth of income, and still be able to, you know, to live comfortably without having to stress, right? Can you say the same thing about renters? Unfortunately,
or even
not.
Your investments, even unless you're an aggressive stock market, you know, negotiator or gambling pretty seriously, those numbers just don't happen every day. This is why most people jump into real estate, because of its consistent need, and it's something everybody needs. Mm-hmm. So why aren't there more homeowners in the market? One of the statistics to keep in mind, the peak of home ownership rate was 69%, and that was leading into 2006, 2007. Almost 70% of the nation were homeowners, which means 30% were still paying rent. We're now currently at 64%. We're still not from the peak. We don't have the peak yet, so more buyers need to get to the market. We need to get that home ownership rate even higher if we can, I believe, because that would just completely change the way neighborhoods work on that. All right, so back to the purchase process. We know that we have several different loan programs, conventional, FHA. If you are a veteran of the military, VA option offers you just straight out the gates, zero out of pocket. In fact, as part of those programs, the seller has to pay several portions of your purchase amount. So absolutely take advantage of that option, because it is a fantastic model for you to get into a property today. When it comes to down payment, working with the right lender is going to be important, because most lenders may not be aware of or even participate in down payment assistance programs. Here in Nevada, we have Home is Possible as being one of the major sources of grant money. We also have Nevada Rural, which provides several different down payment assistance models that you can couple with your purchase price and any negotiations that go with that. Nevada Rural does have a variety of different programs. Some of them are restricted to specific areas. Some have some time limits on it. Others can be coupled, like with IRS tax write-offs and stuff. You need to talk with the lender to find out exactly which ones you would be available, especially for the property. So it's going to be a combination of working with the agent and the lender. So working with the right lender is going to be super important. So while we do have all of those loan options that are out there, the conventional, FHA, VA, being able to couple that with a down payment assistance program is going to be super important. There are many lenders who can provide the processing of a home purchase. but only a portion of them are going to be qualified or even want to work with these down payment assistance programs because there are rules that prevent them from making as much money as they typically would in a transaction. So working with a lender that is an expert in these down payment assistance programs is actually to your advantage because there are specific rules that they have to play by, and that you as a buyer will need to qualify for. There's a lot of variables that are tied to these programs, things like location of the property, as well as your income and adjustments. Your qualifications will have as much as an impact on those options. But just know that there are at least a dozen or more different options that you can pick from to help you in your down payment assistance.
And keep this in mind, guys, and I'm gonna tell you guys the cold hard truth about down payment assistance programs that lenders probably won't tell you, is that lenders actually don't get paid for it. They actually, it costs them more because it's more paperwork, it's more time consuming, it's more tedious. So it's only a handful of lenders that are willing to put in that work for their clients. And so it's very important for you to really get a second opinion or start working with the right person who is familiar with that, which is why we aligned ourselves with this particular lender, because of their diligence, their work ethic, and most of all, how important it is to them to help the client out.
Let's just say it. Scott Reynolds.
Oh, we're at Evergreen.
Okay, Evergreen. Hashtag Evergreen rocks. But with that,
and they're not sponsoring this video.
They are not sponsoring this video, by the way. Home is Possible is one of the programs here in Nevada that absolutely offers some great programs. If you are a VA, if you are a veteran of the military, the VA program is just straight out the gates a phenomenal program. And yes, you can couple this along with some of those options. If you are a teacher, if you are a first responder, there are programs that are available just for you that you can take advantage of. If you're purchasing a home in certain districts, Nevada Rural will be available to you as a phenomenal program to be able to get a really, really awesome house within the valley, but not necessarily within the city district. Again, each program has its own unique rules and circumstances, so definitely jump into those and understand what those are. As far as the down payment assistance programs, is that where we left off with Maria? Is that how we got into Maria?
I think we were talking about Maria.
We already did. Okay.
Because how did I bring up? Lino, the 285,000? How did that come?
Oh, okay. So that's actually right here. So yeah, that's
okay.
Right, that's right. So with that, when you consider the numbers, down payment assistance, you're paying out of pocket. Typically, the way that this would work is for about a $300,000 property, you're looking at around $20,000 out of pocket. That's your down payment plus your closing costs plus lender fees. With that said, though, you've got down payment assistance programs that can offer you anywhere between 2 to up to 5% towards your down payment and closing costs. Now, do the math. If you're paying 3.5 or even 3% for a down payment and your additional costs, and yet you're getting 4% for a contribution, and in some cases 5%, you're making out pretty good. You've got some awesome examples of that where they've got minimum out of pocket in order to purchase.
First of all, I want to clarify that in this market, it's not that easy. It takes a lot of patience from both, myself, but the buyers, because sometimes we're out there seeing multiple homes, multiple offers. So if that's something if that's your goal, is to be able to, walk into a house with very minimal, it's going to require a lot of patience and it's going to require a lot of time.
Yeah, and let's be real. Yeah. Like if you're looking to get, an awesome spot for a phenomenal deal in Summerlin or in Henderson, you're going to have strong competition. The reality is you're just not going to get it because there's going to be cash buyers, people that will be able to outperform you.
Back to what our buddy Eric was saying on our last podcast was, actually this was off camera actually when we were talking about this, is he was talking about if you're buying a home and you're trying to come in $10,000 less because it's the best house in the neighborhood, in the neighborhood that you want to be.
Yeah.
Well, there's probably 10 other buyers looking at the same home. Do you really want to take the risk of losing that over a few $1,000s. Something.
It's not a risk. It's a perspective. And the problem is people think they can go and throw a lower offer and negotiate with the seller. But like you said,
and $10,000 is only $60 difference in your payment, right? Yeah. So it's one less sushi outing,
for one person.
But in my case, a particular client, we were able to negotiate down to $15,000 off because of the appraisal. So we were a little concerned that the concessions or the contributions from the seller weren't going to be there. So after a little bit of negotiating, we were able to get some of them. So my client went from walking into his home for nothing to coming out of pocket about $2,500, which is still phenomenal because they were prepared to pay a little bit more on a different home. So for them to go from $15,000 down to $2,500,
right,
just because the program covered their entire down payment, they got an incredible rate, 3.125%, which is insane. And they got it for $15,000 less than what it was listed for. With the seller contributions, their payment is very, very comfortable. And they were smart. And here's the power of ownership. They had another property that they're now renting, and that is going to offset the majority of their mortgage. So they're going to come out of pocket like $300
a month.
For this brand new home that they got, bigger lot size, bigger home, just exactly what they were looking for.
Yep.
That they wouldn't be able to do if they were renters,
right?
Because they had no equity. They can't, sublease their rental,
their other property. And so that's where just getting started is the first step. Just get that done. And let everything else follow its course, but work with someone who knows what they're doing to help you to be able to get prepared for it. Because there are many people who feel like they got burned 15 years ago, and while that market was pretty aggressive and there was things going on there that a lot of people didn't know, we know that now, in hindsight, the market comes back and it will correct itself. Why? Because homes are required. People need to live in homes, right? And so if you're going to do that, if you're going to be living in a home, might as well be yours.
Well, and regardless of a lot of people if you already own your home, then this might make more sense to you. But if you're renting, then you really need to consider the buying, because regardless, you're going to pay for a mortgage, whether it's yours or somebody else's. So yes, the market is going up. We are seeing appreciation. So a lot of people are like, well, why would I buy a house today, Jared? Why would I go spend $300,000 house? I'll just wait till the market tanks, and then I'll just buy the same house for $50,000 less. Now, first of all,
I'm not going to talk about the market because that's a different video.
Yeah, but we can't predict that.
Right.
Maybe it does, maybe it doesn't. Nobody can guarantee that it will, right? So that's one. Two, if let's say that it does happen, let's say it happens in 2 years, again, $1,300 in rent, we're talking about, I don't know, $15,000 a year. So that's $30,000 that you're going to throw away for the next 2 years.
Yep.
So let's say that you do buy this house for $30,000 or $40,000 less than what you would buy it today. You still came out of pocket that much, because you just spend it in rent.
Right.
But if you buy it at today's high price of $300,000 or $350,000, you use this down payment assistance that covers some of your money. You come into the house for very little out of pocket, right? And 2 years from now, that $30,000 that you would have thrown away is now built into your equity.
Yep.
So at worst case scenario, you break even.
Worst, and that's speculation.
Right.
Not to mention today's rates, historic lows. So as a renter, by renting your property, you're making your landlord rich. You're not going to get that money back. Regardless of what happens in the market, your monthly payment is going towards your future wealth. 30 years. Afford that payment, make adjustments, make it happen, make that payment happen, and you own that property outright, and you can then at that point do whatever you want with it. Give it to your grandkids or to your family and go from there. Interesting email comes in right now at this very moment in the middle of our conversation.
Why are you checking your email during our podcast?
Hey, well, a homeowner's net worth is worth 40 times more than a renter's. And so the increasing gap in family wealth, establishing your family wealth, really starts with home ownership. It really starts here, and that's part of one of why our key points is helping folks get into their first purchase. One of the reasons why we help first-time homebuyers is to eliminate the mystique or the mystery of how to make it happen, and that's why we're here.
I was just this morning, part of my morning routine is to hear something motivational or something uplifting, right? And I was listening to Casey Nice. I can't say his last name, but you guys know who he is. Big famous YouTuber, right? And he was talking about why he wakes up at 4 a.m. So that's kind of why I was watching it, right? And so we'll throw a link there. We'll tag him, so you can see that video. But he was talking about discipline, and he was talking about how discipline equals freedom, and who doesn't want to be free, right? And he talks about, he briefly mentioned it. If you want to buy a house, you need to be disciplined, and that's what it comes down to. It's so easy to get sidetracked. It's so easy to go spend money on other things. But at the bottom line is, what is it that you want? And if you want it, how bad do you want it? Because if you really want to be a homeowner, you want to have your own place, your own backyard. If you're living in an apartment, you don't have a backyard, right? You want to be able to invite some friends over for a barbecue or whatnot. Yeah. Especially right now with quarantine. Oh, yeah. Being cramped up in a 1 or 2 bedroom apartment is probably not the best.
Yeah, you can't entertain. You can't even do anything with it.
Exactly. You got to be quiet. You got neighbors. All that stuff. So if it is that your goal to be able to buy a home, then don't use the fact that you have no money or no savings or the money as an excuse. Mm-hmm. There is a way. So really, it comes down to credit.
Credit, yeah.
Right.
That's right. And fixing that, we just talked about earlier, is really easy, even if it is bad, or you need help with it. There are solutions. So if you're eating at McDonald's or buying out or getting a Starbucks or even buying fashion items that you can get away with maybe purchasing on a less price point for a short period of time, the vision, the goal, your objective of owning a home should be more important than a lot of that stuff, especially for families. Because when you have ownership in a community, the family environment becomes more. You're more interested in what your neighbors do and more, how everybody wants to take care of each other. Just seeing my boys grow up in our community is encouraging and exciting for me because, random knocks in the middle of the day from the kids next door because they want to go play. Those little things brighten my day. Not because I get to have a few minutes of alone time and I can put my headphones on, but the fact that they got that kind of experience to kind of get out there and have fun. Yeah, go take a ride, go to the park.
And I think it's the way we grew up, because I remember having those door knocks for myself, and one of the neighborhood kids coming over and asking my mom if I could go out and ride my bike or play, and so I think for you maybe it's a kind of a reminiscence of that. Absolutely. Of your childhood. And so and those are little things that you could do in your own home, have your own privacy, have your own just that satisfaction of having your own home. But again, it comes down to setting your goals, getting down and putting a vision together and saying, okay, what do I need to do to make this happen? Yeah. So I had a personal goal of paying off my entire debt with the exclusion of my auto loan, because that's a lot more. And I did it. I want to say that I'm proud of myself, not bragging or anything, but I set this goal. I said I'm going to pay this off, and I did it. And it took discipline. It took quarantine help because there was no more restaurants to go out. But it really comes down to, where is your money going to? If you're going, like Jared said, stop going to Starbucks. Get some instant coffee. Go get yourself a $50 Keurig and get the Starbucks coffee that's going to run you 60 cents a day versus, $7, $8 a day. Yeah. That alone is going to save you money. Stop eating out. Pack your own lunch. Do this for a year or two to save up enough money to pay off down some debt, or hire a credit repair agency to help you out. Make it happen, and then give us a call when you're ready, so we can put you in the right program. Yeah, give us a call now.
We can help you work that out. So with that said, I know that there is a segment that's out there saying, you know what, you don't know what my situation is like, and I'm maybe a single parent, raising a couple of kids with absolutely every ounce of my dollar. I'm saving and budgeting, penny pinching. You know, those special, unique cases, there is even an option for you. And don't lose hope. We can help you figure that out. I'll give you 2 examples. While they have a completely different set of requirements, they're a different path altogether, there are options, and this is the point. If you have horrible credit or you have absolutely little money that you need to work with, Trio is a lease-to-own program which allows you to take your positive rental history and use it for the next 2 or 3 years and put it towards your down payment in a house program. It is a 3-year program, and it does require specific things. But the cool thing is there's no down payment required. You have set payments already established, and you can look to basically be a homeowner within 3 to 5 years of that time.
And the other thing, if I'm not mistaken, is that it is you are assuming the current FHA loan.
That's right.
That means that you'll get today's rates. So even if the rates go up in 3 years, you're still going to be locked into today's rate that you got. Yep. So that's a huge advantage. You get that gift of equity from them.
Yep.
So, you know, in worst case, if you don't like the property after a couple years, you can actually move to another property or exit the program.
Exit the program at that point. Yeah, there's certain rules tied to that, but I mean, at the end of the day, being a homeowner and taking advantage of rates on that, they qualify for 580 or higher.
Mm-hmm.
Now, let's say you've got horrible credit and you still want to do the home purchase program. There's another company, a specialized mortgage lender called NACA. They do have a history with mortgage lending, and they have made changes and adjustments that help streamline the process to a much shorter period. But long story short, the NACA program gets really involved into your day-to-day finances, and you are technically using a conventional loan with Bank of America. And their set rate is phenomenal. In fact, probably even better than some of the loan programs that are out there. And so if you are willing to go through that program and get certified, you can actually run through that course and take advantage of the NACA program. 0 down payment for you if you run the numbers right, as well as being able to take a distressed property, one that's probably beat up, and remodel it as a part of, or improve it as a part of the purchase program, so that you're actually walking into a fresh new house. So that said, there are no excuses why people should be renting. There are many different ways that we can make it happen. It's simply a matter of A, working with the right person, and B, getting the program that works best for you. And that's why we're here. We want to help you get there and make that happen.
And even if you are only temporarily here or wherever you are, there are still options for you to buy, become a homeowner, and then later become an investor and have some residual income. So regardless of which way you look at it, there's always a reason to be a homeowner or a property owner. So give us a call. Let's sit down. Let's talk about your specific situation. Let's explore your options. Let's have you choose whether it's you buy today or you buy a year from now. Our goal is to help you, go through that process in an easy way and for you to know all your options. You have a saying, right, Jared?
The right information the first time.
That's right. So we want to make sure that you get that information correctly and that you can make the best decision for yourself and for your family.
Nothing better than making an informed decision instead of guessing. Anything else, my friend?
That's it. We covered it all.
That does it for today's episode of the Rain Ordonez 5 Diamond Group Podcast. If you enjoyed this episode, please be sure to hit that ding on the like button. Click subscribe so you get notified of any new videos that we post, because we are actually posting quite a bit lately. It's a lot of fun.
And if you guys have any ideas or anything that you guys want us to cover, please drop it in the comments below. Shoot us a DM. Our contact information will also appear somewhere on screen, so you can also text us if you want. Follow us on all the social outlets. Drop in any comments, requests, questions, and that'll do it for today. Thank you so much for watching. We'll catch you on the next one.